Welcome back to this month's edition of CAP STRAT Wealth. Thanks for joining us here, Carrie.
Thanks, Neil.
Lots to cover as usual, and this time we're talking about year-end planning. With December 31st rapidly approaching, we wanted to focus just on a few items that we're having regular conversations with our clients. Certainly, if you are a private wealth advisory client right now, ultimately these are part of the checklist that we're going through on a regular basis and doing a deep dive here with our year-end planning. With our clients, we're going through really over a 100-point checklist, making sure that we can really kick the tires on all things financial. And right now, what we're going to focus on is just 2 or 3 items that we want to bring to light. But as you can see, the list is much broader as we kind of organize this in a few different quadrants. So we encourage you to review it and obviously see what's going to fit for you and be proactive here before the end of the year. So let's jump into our first topic, which is extremely popular, especially before the end of the year, which is charitable giving.
So one big piece of our annual review process is working with clients to come up with a tax-efficient charitable giving strategy. We find that a lot of people default to donating cash, and that makes sense because you use cash to pay for other things.
Right.
But we like to bring some of these ideas to the table during these reviews because there are potentially ways that you can be tax efficient with your giving. So one way that we bring up with clients is donating stock directly from your taxable portfolio to charitable organizations. To kind of determine a good stock that might fulfill your charitable goal is to look for stocks in your taxable portfolio that have large unrealized capital gains. So stocks that you've owned for longer than 1 year and have significantly grown in value since the time you bought them might be good candidates to donate directly to charity. Some benefits of going about your donations this way is if you are not liquidating a portion of your portfolio, you have the opportunity to potentially minimize capital gains.
Especially as we look at other parts of portfolios that have grown more than others, this is also a way to even think about rebalancing your portfolio by gifting a position that is highly appreciated to bring you back in line with your targeted allocation that you want to maintain going forward.
You might be familiar with the idea of a donor-advised fund. This type of account has really taken off in recent years, and that's because this type of charitable account can allow people to be even more flexible with the way that they fund their charitable donations as compared to just donating stock directly. So the general premise is that you can gift the highly appreciated stock that you're looking to donate, but instead of donating it directly to the charity, you can contribute it to your donor advised fund. That way, we didn't mention this before, but you can, if you are itemizing your taxes, you can still capture an itemized donation or an itemized deduction on your taxes, and you can still benefit from that management of long-term capital gains. But the idea is that you have more control over the way that the dollars are actually distributed to the causes that are important to you. So to give you an example, if you wanted to donate $10,000 worth of stock and you did it in a direct fashion, you would be donating $10,000 worth of stock directly to that organization. That's simple. But with a donor advised fund, you can donate that $10,000 of stock to your donor advised fund, and maybe you decide you want to support several different charities. You could use that $10,000 donation and spread that out over really as many charities as you want.
Yeah, so that can act as like a hub, right?
Mm-hmm.
Yeah, you put the money in there from a stock grant or donation, avoid capital gains, but then you can use that as your distribution hub.
Right.
So I think the other thing to add there is, Schwab and Fidelity are large donor advised funds out there. So when you put the money in there into a Schwab donor advised fund, for example, you're getting the tax deduction to Schwab charitable. Mm-hmm. And then as you distribute that out, you're not getting any additional deductions for that. And the nice thing is you only have to track really one donation there.
Right. So this leads us to stacking.
Perfect.
So stacking is a concept that can also allow you to be flexible with the timing of your donations, because anytime that you make a contribution to your donor advised fund, you can capture an itemized deduction in the year of that contribution. So what if you are, for instance, expecting a really high income year in 2024, for instance, and then let's also say your $10,000 a year, or your $10,000 charitable budget, let's say that you want to do that for 5 years, so a total of $50,000 to charity over 5 years. If you are expecting that high income year this year, and you might not necessarily have enough itemized deductions to get you past the standard deduction, you could potentially consider stacking all 5 years worth of, or fewer, but for this example, all 5 years worth of charitable donations into 2024 and capture a much larger charitable itemized deduction and lower your taxable income for the current year. Finally, there are qualified charitable distributions that you can make from a pre-tax IRA specifically. The couple benefits to hit on here: monies that are donated directly from your pre-tax IRA to charity are excluded from your taxable income. So it can be a very tax-efficient way to make charitable donations. And two, these donations can count towards your required minimum distribution. So another important note is that this is a strategy that's only for people that are age 70 and a half or older, but it can be a great way to A, donate to charity, and B, manage your overall taxable income for the current tax year.
12/31, December 31st, that's also an important deadline for a lot of not just charitable gifts, but also making contributions in the specific account. So this is a nice highlight of some areas that we do focus on, and why don't you take us down the line?
Sure. So several key pieces of information to keep in mind for all different types of account structures. 401ks and 403bs, make sure to get your employee contributions in before 12/31. If you are under 50 years old, the maximum is $23,000. If you are 50 and above, you have an additional $7,500 catch-up available to you. IRAs and HSAs, the funding deadline is the tax filing deadline. A reminder for IRAs and Roth IRAs, the max for under 50 years old is $7,000. If you are 50 and above, you have an additional $1,000 catch-up available. 529 accounts, make sure you get any contributions in if you want a state tax deduction on those state-specific plans. Make sure you get those contributions in before 12/31. Inherited IRAs and or required minimum distributions for inherited IRAs or regular retirement accounts too. The required minimum distribution deadline is 12/31. That is very important. Something that we talk a lot about with clients because you definitely want to avoid any late penalty with not getting those distributions out on time. Finally, the annual gift exclusion. If you are someone that likes to give to loved ones, you have the opportunity to give $18,000 to as many people as you wish without filing a tax or a gift tax return. So if you are married filing jointly, you and your spouse can actually give a total of $36,000 to as many people as you want.
Yeah, so for the 401k and 403bs, if you are wondering how much you contributed so far this year, make sure you check out your pay stub or the plan provider website. We'll give that summarized information. And I always state that if you are turning the magical age of 50, even in December of this calendar year, then you do have the ability to make that catch-up contribution throughout the entire calendar year. So you don't have to wait until you turn that magical age of 50. And then just in regards to the annual exclusion amount, keep in mind you can always give more than that. Carrie mentioned that you do have to file a gift tax return. There's no taxes if you give above that $18,000 number. When you do file that gift tax return, it just reduces your lifetime giving amount, which ultimately right now is $13 million per person. Which is also set to reduce or potentially cut in half coming up here in 2020, the end of 2025 and starting in 2026.
Awesome. So screenshot this, keep these deadlines handy. This is really important to make sure that you satisfy all your savings and distribution obligations before the end of the year.
So the final topic we're going to talk about is really just tax planning. And this is always important. As we always say, we're not tax advisors. We do not do tax returns. But we also want to be, what we say, looking out the front windshield to prepare for events that might be coming up, whether it's here in this calendar year of by December 31st, or starting to look into future years. And we encourage everyone to be looking at things proactively versus waiting until they just do their taxes in the next calendar year. So let's take a look at this slide and think about some of the highlights of why this is important. Scenario 1 here lays out, we'll call it the current year. This is important as we think about all the activity as we come into the later months of the year. It becomes a little more clear of how you're going to end up from a tax profile standpoint. So you can take a pay stub and start to add up your wages, your total withholdings, also start to focus on the dividends and interest that have been accumulating that you can ultimately annualize for the balance of this calendar year. So right away, some of the items this is going to tell us is first and foremost what your total tax is projected at. This is important because if you're significantly under withholding, then you might have a tax surprise or a larger tax bill due in April the following year, or you might have to make a estimated payment or a larger estimated payment coming here by January 15th. What this also starts to tell us is not only your marginal tax bracket. So if you're going to make any tax moves before the end of the year, like a Roth conversion, would give us an idea of what the marginal tax rate would be on that. But then the effective tax rate, which is kind of more the average tax overall. So some things you can just bring awareness to by the end of this calendar year that can help just with the planning going into 2025. But these other scenarios start to lay out what the expectations are from, for example, if you stop working. First scenario shows that you're currently employed. The second scenario shows what happens if you are no longer employed and all that income drops off. Well, the expectation is that your taxable income is going to drop, which it does in this scenario. So in this case, what we're showing is the wages went to zero. Everything else is pretty much consistent with some slight increases. But then at the end of the day, you can see the total tax went way down, but the marginal tax rate is actually at 10%. So what this starts to tell us is that while you're actively employed versus when you're not employed, there's a big gap between those overall tax brackets. Then as we start to look at the last two scenarios, it shows what actions can we start taking to ultimately maybe lower the taxable impact of the required minimum distributions that Carrie was highlighting earlier that talks about at age 73 or age 75. Now, this is money that's forced to come out of your pre-tax retirement accounts, and it is all ordinary income tax at that point. So as we look at scenario 4 here, ultimately the overall taxable distribution, when they look at their distributions at that point, are going to be around $80,000. And what that's telling us is ultimately that's pushing that investor up into a higher tax bracket, right around the 26% marginal tax bracket, which at that point is more or less can be a tax surprise or a big change, in their overall tax rate. So how do we smooth that out or be proactive today? And this is just one example of someone doing Roth conversions along the way and ultimately reducing that pre-tax retirement account balance, and also has the opportunity to maybe even reduce their tax rate down the road, or even convert that money at a lower tax rate. So as we look at this final scenario, this shows someone converting $25,000 from their pre-tax account, paying the taxes today, going into a Roth IRA account where the earnings will never be taxed again. And they're doing that, at an overall tax rate of, say, 10% in the marginal tax bracket. So the key message there is, can they be proactive today to avoid potentially 26% tax down the road and pay 10% tax today? That's what we want to identify. So in this case, there's about a 16% difference there between doing it now versus waiting down the road that can ultimately save a significant amount of money, for the tax years to come. So these are just a few examples of why we encourage you to be looking at this every single year. We know every tax profile is very unique out there. But what we say is by looking out the front windshield and being proactive there, to bring that awareness can allow you just to make better decisions before the end of each calendar year.
Let's talk a little bit about how we can really help.
Yeah, and as I mentioned up front, we do a 100-point checklist to really do a deep dive in, all clients' individual financial affairs, just to make sure nothing is missed before the December 31st deadline. And certainly, we just wanted to bring to light just a few topics here that we talked about, but there's certainly plenty more to discuss. So if you are a private wealth advisory client, we're already doing our year-end review process, and we'll be hitting on a lot of these topics along the way. But if you're not and you have questions, reach out to us, let us know, and we're here to support you. Have a great day, and we'll see you next month. Thank you.